All right, good morning, everyone. I'm Andrew Whitaker, and I'm Vice Chairman of Jefferies. Thank you for coming this morning to hear us discuss the outlook for alternative investments. The Milken Conference team has gathered a great group for us to hear, and I'm sure there will be some very interesting perspectives. We have on our panel some of the most successful managers from the alternatives world, and we will hear from them where they see the opportunities today and what the latest trends mean for investors. Alternative investments have been a popular, uncorrelated investment option for pensions and endowments for years, and allocations have consistently grown. Since 2008, public pensions have doubled their investment in alternatives. We're going to start off the discussion by going through some trends in alternatives and give the panelists the opportunity to respond to some general questions and then move on to some more detailed questions. But first, let's take a moment to look at traditional investments. Although bonds have had a great run and excellent returns, with today's low interest rates, buying bonds is not currently viewed as an attractive source of return for many asset allocators. And while recent equity performance has been strong, over the past 6 years, performance has been very volatile, with money invested at the peak in 2007 only recently reaching break even. In addition, the macro growth outlook is very weak, further complicating investors' search for return. Yet it's not clear that alternatives as a class deliver superior performance compared to traditional investments. Although there are obviously some firms, like some of the firms we have here today, that have consistently delivered outsized returns. You can see on this slide that listed equities have had the highest short-term returns, while private equity has had better long-term returns, but recently has lagged. Despite the mixed record of alternatives as a class, pension managers looking to meet return expectations are planning to allocate even more funds to alternatives in a continuing shift away from traditional investments. As this survey indicates, managers believe they are overallocated in stocks, bonds, and cash, and intend to shift even more money to alternatives. However, there's significant dry powder allocated to private equity, and there's over $100 billion from 2007 and 2008 vintage funds that is yet to be invested. In addition, hedge funds have had growing allocations despite mixed returns in comparisons to equities. And finally, correlations are rising, making it harder for skilled hedge fund managers to beat the market. Our first question for the panel is, given this macro environment, where do you see opportunities for outsized returns, and what is your outlook on alternative investments as more funds flow into this asset class? Josh, why don't we start with you, and you can talk, I want you to introduce yourself and your firm, and then talk about where you see your outsized returns in this environment.
Great, thank you, Andrew. And Josh Harris, co-founder of Apollo. We're a large alternatives firm, approximately $115 billion of assets, very large in private equity, credit, and real estate. I would say that if you look at a lot of the statistics, the top quartile performers in alternatives, and particularly in private equity, have actually somewhat trounced the traditional asset classes. So, for example, from our point of view, we've generated about a 26% net return on throughout our history on all of our capital, which is about $30 billion in capital invested in private equity. And during that same time period, the S&P 500 was up 9%. So that's about a 15% outperformance versus the S&P 500. And when you look at the sort of traditional pension funds today, really they have to keep up with healthcare costs that are growing at 8%. And so it used to be that the traditional pension fund would have about 5% in alternatives and 30 to 40% in equities, and the balance in fixed income. The problem is fixed income now, obviously, to invest in corporate fixed income, you're earning kind of 3 to 4 to 5%, if that. And so what you've seen is alternatives grow from about 5% to about 12% of asset allocation. But if you're a pension fund, you really have three choices. You can cut benefits, raise taxes, or try to go up the risk curve and invest more thoughtfully. And what we're seeing is, even though the Fed is infusing, and the monetary authorities globally are infusing tremendous amount of capital into the system, and you're seeing an overvaluation of many of the more traditional asset classes, we continue to see the liquidity premium. If you're willing to invest in longer-term assets that are less liquid and harder to value, we're seeing those assets continue to maintain very superior returns. The traditional private equity benchmark that people target is about 20% returns. And we've been able to generate those types of returns and more, even in today's overvalued world. And I think in order to do that, so we've generated 26% returns in our last fund. In order to do that, you really have to find pockets of arbitrage that exist out there in the world that allow you to actually, in our case, buy very inexpensively, even though today the world is overvalued, as you're pointing out, and returns have come down. And so for us, where we see that value is really in a number of areas where there's excess selling of assets versus people able to buy the assets. And in a world awash in money, you really need special expertise in addition to just capital. So more directly, I'd say today energy investing is actually incredibly interesting. And what's driving that is that the shale technology has opened up literally trillions of dollars of very high ROI capital projects right here in North America. And there's just not enough there's not enough companies to be able to really take advantage of those capital projects. The U.S. has gone from being a high-cost producer of gas to a low-cost producer of gas, and has gone from being a high-cost producer of oil to in the middle of the global cost curve. And so you're seeing trillions of dollars of capital investment opportunity that literally you can generate 25 to 45% rates of return. And even though the major oil companies are really big, they can't take advantage of it. And so if you have special expertise, if you have the ability to, if you have landmen, reserve engineers, teams of scientists, you can actually invest and develop oil reserves right here in the U.S. at, sort of a third to 50% off the futures curve. So if you can buy oil today at $60 to $65 a barrel in the ground and then hedge it, that becomes a very interesting opportunity. And that's one area that we see really excess return. Another area we see excess return in is really in distressed, even though, as you were sort of pointing out, that the fixed income spreads have come down and there's not a lot of defaults in some of your charts. There's still continues to be a big hangover of some of the large buyouts that need to be restructured. So the ones that have been in the paper recently have been TXU, Cengage. We've been all reading articles about those companies restructuring, and in many cases, the huge buyouts that were done in 2006 to 2008, those all, some of those really were done at very high prices, and even though they've been able to extend their capital structures, those debt structures need to be restructured. And whenever you have, a company with 10, 20, 30 billion of debt that needs to become a much smaller quantum of debt, that creates a lot of excess selling pressure and a lot of complexity, which allows excess return to be generated. The last area that I'd point out would be European banks continue to sell down large swaths of their asset value in their book. And so when you look at it, the European banking system on average in every country is about 3 to 4 times the GDP. So European bank assets are about $65 trillion, and European GDP is about $16 trillion. And so that's just too leveraged. And so you are seeing, significant asset sales of what I technically refer to as stuff. Consumer loans, mortgages, commercial loans, anything that that has some restructuring need or is difficult. So we'll get a call from a Spanish bank, and we got this recently. We have 10,000 consumer loans we'd like you to buy. Make us a bid. And again, we've developed servicing, people all over the continent to be able to manage and collect and deal with working out and those types of loans. So those provide significant purchases of at a big discount. We've acquired about $12 billion of loans over the past 36 months from European banks that need to deleverage. So those are sort of some of the areas that we're seeing real value and really the ability to buy cheap, to buy at a significant discount, even though the world is awash in liquidity. And I'll just end by saying that the banking sector, the global banking sector as a whole, is being managed down and being managed to being a utility. In some sense, the banks are all being de-risked. So as the banks exit asset classes, particularly in credit, the people with long-term capital, such as sovereign wealth funds, pension funds, endowments, family offices, teaming up with people like us and other alternatives firms that have special expertise that sets them apart and allows them to do things a bit differently, are going to continue to see this ability to earn excess return over what other people can earn if they just look at a Bloomberg or get a rating from S&P or Moody's and buy what's easy to buy.
All right, thanks, Josh. Vinay, I think you have some slides prepared that you want to walk through to
Sure.
set up your answer.
Absolutely. I represent Brevin Howard Asset Management, one of the largest hedge funds in the world. We're based out of Europe, the US, and Asia. We manage about $40 billion. This is a macro fund, and that'll be the theme, with a few remarks that I have to make. Sometimes it makes sense to start with to state the obvious. If you could show my slide 1. Judge for yourself how unusual this world is, but not unprecedented. Okay? What these slides are showing you is the one-year holding period return. I've just chosen the S&P as an example. It makes for a good display, and I have lots of data. This is the one-year holding period returns starting on the top left since 1927 for the S&P. Please see how it is distributed. Look at the x-axis. Notice the positive drift. That was top left. Bottom left, the 80s and 90s, the time period when certainly I cut my teeth in this business, many of you as well, and certainly the textbooks that have been written about money management really are built on this period, on the experience of this period. Notice how mean reverting this period was in terms of S&P returns, but notice how much larger the positive drift was. Now, please contrast that with the two slides on the right. Top right, my business career started in the late 70s. That's the 60s, 70s experience. Not even remotely like the first two slides I showed you. And now, the times we live in, the last 10 to 12 to 13 years. Your first class in statistics will help you identify this as a bimodal distribution. Never mind bimodal. Please look at the x-axis. Those two peaks are at about plus 15 or minus 15%. Why is this so? Right? I mean, this will be a long discussion, probably not for today. But you can see the opportunity in the macro space. This is fundamentally macro risk that has driven these extreme returns, plus or minus 15 or worse. And the cause of this, I'll put it very simply, is I think the opportunity set and the risk set that has been introduced by the integration of emerging markets into the world, and the great difficulty the advanced world has had in adapting to this change, and the greater difficulty, some of it unnecessary, that policymakers have experienced in addressing the downside, the risks that have come with this integration. This presents, for macro traders, enormous opportunity. It's a world of depressed wages, depressed interest rates. If you get a smidgen of growth, Andrew was talking about very low growth, but if wages are very depressed and interest rates are very depressed for a variety of reasons, you would expect those gains to go overwhelmingly to the owner of capital. But God forbid, if you have a recession or a crisis, in advanced societies like ours, wages are sticky on the way south. Interest rates are so close to zero, there aren't many basis points left. And I'm sorry, a recession comes out of the hide of the owners of capital. That's how you get these kind of distributions. Where do we see opportunity? If you could flip quickly forward to slide 5, my slide 5. What we seek is, on a macro basis, convexity. Okay, this is a big word. It simply means to recognize that in an unstable world, you want to have the most responsive asset mix or portfolio possible for both kinds of environments. There are 4 areas of opportunity and risk. The epicenter of risk in the world, as I think Josh was alluding to, is Europe. Unfortunately, a zero-sum game, not easy to resolve. The second center of opportunity and risk is here in North America. The third is the emerging market space, which we might talk about later. And the fourth, suddenly out of the blue, comes Japan. This has been a tremendous macro opportunity for us and other people in our space, a country that we had basically given up for dead. The move in dollar yen and the move in Japanese equities has been nothing short of spectacular. And people who understood that this was a very, very distressed asset class, a small change in the climate would have a dramatic impact, but a very, very large policy response, which is what we are seeing, will have an extraordinary response. That is an example of the sort of opportunities we look for and exploit. And as long as the world stays unstable, I suspect there's another 5 years of this, at the very least, these sort of opportunities for convex portfolios of the kind I'm showing you in the bottom center of this page will exist. It's a combination of finding asymmetric assets, long and short, top left, and asymmetric volatility, derivatives, top right, to mix and match, to produce the sort of payout you see in the center. Some places in the world, policymakers are making progress, for example, the US. Some places it's slower, for example, Europe, bottom right. Thank you.
Thanks, Vinay. Julia, given your expertise, you might have a slightly different outlook on alternatives than the rest of our panel. Why don't you tell us about yourself and your outlook?
I'm Julia Lawler. I'm Senior Vice President of Global Investment Services with the Principal Financial Group, and our organization manages both institutional and retail money. Clearly, our view is that alternatives will play a key role for both institutions and, more importantly, for retail investors. But anytime you start with a question that says outsized returns, I hesitate a bit, because I think given the amount of money that is coming in and will continue to come into this space, I think we need to temper our view around returns. But I do think that there are key places where we can find better returns, and several have already been mentioned. So I might just mention a couple others that I think that we can find places for return. First is commercial real estate. This is my background, so I am a strong believer in this, and so I'll recognize my bias. But I do believe both in the US and globally, commercial real estate will continue to play a great risk-adjusted return for institutions' portfolios in particular, but also retail portfolios. So I'm a key proponent of commercial real estate. And I also think that plays into the point around European banks. Not only are they having to delever, but Basel III is going to impact all commercial banks, whether they're in the US or outside the US. And I think that continues to play in all real assets that they're holding on their balance sheets. So I think infrastructure will be another place to look for better returns. And I think that'll predominantly be outside the US. I think that the amount of growth, particularly in the emerging markets, that's a key place to look for opportunities. So real assets, in my mind, are probably a place to look for more risk-adjusted returns, and particularly in the emerging markets.
Thanks, Julia. Wilbur, you've been very successful in different investing environments over a very long period of time. Why don't you tell us your perspective of today's environment?
Well, I second some of the things that have already been said. In terms of the European banks, I think there are two opportunity sets. One is the assets they're disposing of, and then the other is reprivatizing banks that have been seized by the governments. We did Bank of Ireland not so long ago, which has turned out to be quite good, reprivatizing that from the government after the banking collapse. Same thing with Northern Rock on behalf of Virgin Money. So I think it's not just the assets themselves that they're selling, but also the cleaned up banks. And I think where the most fruitful picking for assets will come, it's not so much from the banks themselves, but more from the good bank, bad bank setups that are coming into place in many countries. Problem with the European banks before they're seized is, by and large, they haven't marked properly to market their portfolios. And that's why there hasn't been nearly as much paper come out as people thought would, because nobody wants to sell you an asset if that crystallizes a loss that he hadn't already booked. So when it gets put into the bad bank, for example, in the case of Ireland, they set up a government entity called NAMA, National Asset Management Administration. It bought real estate loans from the banks more or less at 40, 50 cents on the dollar. Maybe that's a right mark, maybe it's not, but it's a lot closer to a right mark than where the banks had it before. As those assets start coming back out, you'll also find that the entity selling it will probably provide very cheap seller financing, and that will magnify the returns. So I think that whole category of buying both assets in the form of loans and whole banks from governments is going to continue to be a very satisfactory business. Second is real estate. And there, I think, maybe emerging markets, although to me that's getting to be a very crowded trade at this point. We're finding more that in the US, you need to go to secondary and tertiary markets to get a return. And to make a real return, you have to take development risk and or rent-up risk in order to get really big numbers to come. So it's no longer just buy it, leverage it, hold it, and let inflation grow. We think now you need to be a proactive manager in order to get significant return enhancement. The other place we've been doing a lot is marine transport. As you know, it's a huge industry, tens and tens of thousands of vessels on the sea, and it became a victim of its own prosperity. A few years ago, charter rates were enormously high. The stocks all went crazy. Used vessels, 5-year-old vessels, were trading at a premium to brand new vessels because people were so eager to get steel on water. So naturally, then Wall Street and the banks threw too much money at it, and that has caused a tremendous collapse in rates. Rates in most sectors are down 80%, 85% from the high, and probably are going to stay down at least through this year, maybe on into next year. Because what's finally beginning to happen is we're working through the new delivery book, and ships are being scrapped at earlier and earlier ages than they had been before. And in fact, in the fourth quarter of last year, there was pretty much balance between new deliveries and scrappage. And we think that probably will tend to continue this year. So comes 2014 or 15, we see a very big turnaround in marine transport, partly driven by the shale phenomenon here. Between that and the advent of more and more refineries in the emerging markets, who are by and large producing more refined product than the local market needs, so they'll export it. Well, what that means is now you have a huge amount of ton miles to take the crude over to those markets, and then huge amount of ton miles of product carriers to get it back to markets where it'll be consumed. So we think that plus the changing technology in vessels is going to make for a very, very interesting turnaround in that space. So in general, our feeling is that in a market making all-time highs, about the only place you can go is a place where there's some idiosyncratic problem peculiar to that sector or a subsector.
Thanks, Wilbur. Josh, you talked a little earlier about the opportunity in distress for large companies, and we have a chart up here showing how distress as a percentage of the market is down dramatically. And in addition, the wall of maturities that people spoke about a couple years ago has virtually all been refinanced out, so that there's very few companies left that need to refinance. So where else, other than in large companies, are you seeing opportunities today, currently in distressed?
Yes, I think what you're seeing now is the the high yield market at 570, and then you're seeing companies put 6.5, maybe even sometimes as much as 7 times debt to EBITDA on their balance sheets to consummate transactions. So, when you see the high yield market at below 6, my suggestion is run, do not walk, run the other way. And so when you see sort of fixed income, approaching, bubble-like status, when you go back and you say, okay, the leverage stats that existed over the last 15 years, the rates that existed over the last 15 years, and you compare what's going on today in the leveraged finance markets, you'll notice that it's really only 2007 and the first part of 2008 that looks like similar statistics. And that would go for dividend recaps and covenant light deals and all the terms. There was more dividend recaps this year than in 2007 or in the last 12 months. And so what that is that's really the creation of the next distress cycle. And really, it's a product of the fact that the global monetary authorities have expanded their balance sheets upwards of $10 trillion. So when you compare that to a global economy of $65 trillion, there's just a tremendous amount of liquidity going in to the system, not just here, but in Japan now, and China, and the UK, and the EC. So really, when you add it all up, there's QE1, there's QE2, there's QE3. Japan is probably QE 3.75. Europe is QE 4.5. And so you're seeing that sort of lowering of rates and the excess liquidity kind of reverberate through the high yield market and even into the equity markets now. And so you're seeing really technicals driving the fixed income markets ahead of fundamentals. And so I would say that today it's the large buyout sort of overhang that's being, worked out, as well as, some companies in Europe. There are a lot of great companies in Europe, but if you're producing in a Southern European country, whether or not you've got a great company, it's going to be very hard for you to refinance your balance sheet. So there's some distress there as well, but that's probably what exists. But what you're seeing is the advent of the next distress cycle, and I think our view is what's going to cause that? Probably some unknown volatile event, whether it be a geopolitical event, whether it be Europe, some sort of a kind of issue in Europe, or if nothing happens, it'll be ultimately when the Federal Reserve and the other monetary authorities start to rein in credit. And when you look at a tightening of credit and rates coming up and leverage levels going down, you'll see what you'll find is a lot of companies that put too much debt on their balance sheets won't be able to refinance that debt. And so, my advice today is to be a bit patient. It is very hard in a fixed income market, awash in liquidity, to find great opportunities. They're out there, but as Wilbur was saying, as others were saying, you have to pick through a lot of sectors, and certainly shipping is a sector where there's excess selling and some opportunity. But really, it's coming, and it's probably coming 6 to 18 months from now when rates go up. As the U.S. economy ultimately approaches full employment. The Fed's put out there a 6.5% target. As you see, if nothing else happens, as you see the economy approaching that 6.5% employment target, you'll see really the quantitative easing that's going on probably start to get tightened a bit, and I think that'll cause the next series of distressed investments.
Thanks, Josh. Wilbur, do you see any pockets of opportunity out there in distress today?
Yeah, just to pick up on a couple of the points Josh was making, a company that has 1.5 times interest coverage now at a 570 number on the bonds, if that bond now at refinancing time requires an 8.5, there is no coverage. So there's a tremendous amount of interest rate refinancing risk being built into the paper that's put out nowadays. 60 some odd % of all the high yield bonds done last year were refinancings. And if you add in the ones that were LBOs, dividend recaps, and such as that, it's over 80%. That means over 80% of the issues didn't add a thing of value to the company. No more working capital, no more capital expenditure for expansion, just reshuffling the balance sheet. And the very fact that the preponderance of it was refinancing means that they weren't generating the cash flow to pay down the old debt. So what's being built is a bigger and bigger time bomb. Now, that time bomb probably doesn't go off until the next wall of maturities, which really starts around 2018 into 2020. You've got $500 billion a year on average coming due in each of those 3 years. That's a huge, huge number. And it was fine to absorb that in today's permissive environment, get to more normal environment, and it will be a huge, huge problem. The few ones that haven't been able to get financing this time are the ones that have gone bad, but it doesn't mean that all the ones who got it are healthy. Something like a third of all the first-time issuers last year were CCC or below in terms of their rating. That's not a very good crop of names. So there's no question that time bomb is coming, but I think it's also coming not just in high yield. If the 10-year US Treasury simply went back to its average yield from 2000 through 2010, not some sky-high number, but just that, you know how much it would go down? 23%. 10-year Treasury, 23. Well, if there's that much downside risk in the 10-year Treasury, tell me what it is in high yield, tell me what it is in normal corporates. It's got to be bigger than that. So I really do think that a few years from now we'll look back and say the real bubble was debt, and especially the low-quality debt.
Yeah, the traditional fixed income markets today, which are perceived to be safe, whether they be government bonds, whether they be agencies, whether they be high-grade fixed income, and now even high yield, ultimately anything with duration really is being affected by the U.S. government and other governments being on both sides of the trade. So you have to ask yourself, if the Federal Reserve is buying 50% of all treasuries issued in excess of 10 years, if the Fed stopped buying those treasuries, what would happen to the 10-year Treasury? Where would it trade? Would it trade at 360? Would it trade at 460? And to Wilber's point, you then just have to multiply through by the duration, and then out of that comes how much money you're going to lose. So I think that when the buying stops, and inevitably the laws of economics have not been suspended, ultimately you can print as much, you can print a lot of money, but ultimately it does raise inflationary expectations, in my view. When that printing stops and when those buys stop, the government bond markets are all going to go up in rate, a decline in value, and that will sort of spread across all of the fixed income markets. And so when you're buying anything with duration that is not an arbitrage, that is not for whatever reason distressed, or that is not for whatever reason presenting itself as a value opportunity because it's complicated like shipping, because it's in a sector that can't get financing, anything that is normal and liquid and safe and easy to value, in my opinion, is actually got tremendous downside. And so it's the question that you raised initially, Andrew, which is, should we be going into alternatives? I think the corollary of that question is, should people be in traditional fixed income today? And how do you get out of traditional fixed income before the coming decline in value, which is inevitably going to happen?
That's an interesting perspective.
That's an area of controversy. May I step into it?
Yeah, go ahead. How do you see this affecting emerging markets, let's say?
Also, yes, I'll come to emerging markets in a second. The points Wilbur and Josh are making are obviously absolutely obvious. It presents a large macro opportunity. You make money when interest rates are too high in relation to the economic prospects that we face, and the opposite as well. Let me just home in on the interest rate side because my background is in fixed income. 10-year real rates, 10 years forward in the US, were about 3.5% until 2008. They weren't substantially lower even in 2011. In January this year, 10-year forward, 10-year real rates, that means government tips, were at 0.5%. Okay, we're currently about 0.65, 0.65. The implied forward break-even, that is to say, if you look at 10-year nominal, is about 2.75% above that. That is, the market is not entirely silly. It has recognized the potential long-term inflationary impact of what central banks are doing, and has priced it, somewhere which you can't, it's not a level you can scoff at. So I think you should be very careful in general. I mean, not just you're asking about emerging markets. I mean, this applies to virtually everything you invest in. I think your huge exposure is in the forward real rate, which is extremely depressed, not because of zero interest rate policy, but because of what it is required, what has been required of central banks beyond zero interest rates, which is the QE 1, 2, 3, 4, 5, and 7 that Josh was referring to. In emerging markets, thanks to the world being awash in liquidity, the great opportunity has been in the best credits, especially in Latin America, government bonds, which have seen an enormous rally in the last few months. People are stepping into emerging market credit, highly rated credit there, which trades apparently at the level where financial credit trades in the US. That's not something I step into. Emerging market equities, I think, is what's getting a lot of press, especially given how they've performed since January vis-a-vis the US and developed country markets, and of course Japan. And I think you need to be very careful. I mean, this has to be a nuanced answer. If you go to my slide 3, let me make my point with respect to the US, and then emerging markets follow. Look at the chart on the bottom left. The one on the bottom right is simply a blow-up of the chart on the bottom left. The red line is the equivalent of an asset swap spread in credit applied to equities. It is a classic 3-stage dividend discount model for valuing equities that we all learned in finance. That is to say, if you believe the bottom-up IBES-type forecast for dividends and earnings over the long run, and you discount them by zero-coupon US Treasuries, the way you handle credit, that is the spread you see. The sort of dispute that Josh and Wilbur are referring to is the spread versus the absolute yield argument. This is a tough one to resolve. The absolute yield on most liquid financial assets is either at the low end of the last 25 years, such as equities, or way through, such as fixed income. The spread vis-a-vis government bonds is, however, in many cases, not all, relatively generous. The risk you run is something terrible happens to the economy that central bankers and others are not able to correct or stave off. That is why you have a green line below that red line. That is, people who are in the mortgage world or have cut their teeth in that, as I have, understand this, I think, very clearly. This is the option-adjusted equity risk premium. This is the after-insurance spread of equities vis-a-vis government bonds. I'm adjusting for the level of equity vol vis-a-vis rate vol, the term structure, and skew, all three. And basically, what this is telling you is that the equity vol market is not as concerned as anyone on this panel seems to be. As a macro trader, do I care whether I'm paid off by the option market maker or by the equity itself? Right? And that is what, when I said you need a convex portfolio, that is what I'm speaking about. When you come to emerging markets, they're trading about 200 basis points in general, that is EEM, above the US market, which is at the narrow end, not very far from the lows that we saw in spread in 2008. But you must understand, these are the 3 areas in emerging markets. The biggest is obviously emerging Asia, followed by Latin America, and the smallest is Central Europe and Africa. Latin America is challenged, equities are challenged by very high nominal and real interest rates in many cases, and I don't find the equity asset class quite as interesting as the real returns and the nominal returns that you see there. Emerging Asia That's a two-part story. One part of the story is the FX. The other part of the story is the pure equity. The pure equity is done poorly, but the FX in many cases, especially Southeast Asia, has done extremely well and has been terribly threatened by the 20-25% depreciation in dollar yen that you've seen. I mean, the impact on the Korean economy of a 25% depreciation of dollar yen is there for all to perceive. So I think when you're investing in emerging Asia, you need to be very careful. Is the currency risk really worth taking? Finally, I think there is no question that the BRICS, all 5 of them, have done very poorly. Both 4 of them in FX terms as well. But unlike the US, these are countries where costs are growing. They're virtually all of them at full capacity, unlike us. If you get a reduction of growth, this comes out of the hide of the equity owner, of the owner of capital. Unlike the US, where the shock absorber is the worker and the interest rate and the Fed. That is not true in those markets. So what you see is what you get.
So, Julia, Josh thinks everybody should move out of traditional into alternatives. Now, I know you manage some retail. What's your view on retail now is starting to get some access to alternatives? What's your perspective on that?
Yes, as I mentioned, Principal manages not only institutional money, but also retail money. And for all the things that we've been talking about, risks that have occurred for institutions, imagine the magnitude for retail investors. They've probably been impacted tenfold. So what we've seen really since the crisis is a lot of things happening in the retail market, mostly people running for safety. But interestingly enough, especially in the last 5 years, the impact on alternatives for retail investors is pretty astounding. About $100 billion over the last 5 years has gone into mutual funds where the underlying is alternatives or liquid alternatives, right? So that may not seem like a lot to those in the audience that are particularly institutions, but that's an enormous trend, and that trend is not likely to stop. So I think that has huge implications, both for retail investors as well as potentially institutional investors. So again, a $100 billion increase in the last 5 years into alternative strategies for retail investors. Those are single strategies, multi-strategies. They're going into asset allocation positions. And basically that's saying retail investors, just like institutions, are looking for diversification. And they're looking for diversification that really reduces their downside volatility. Okay? And I think that's really what we're talking about in most of these cases when we talk about volatility, is we're looking for alternatives to help us during crises, right, to reduce our downside volatility. And I think that's what the retail market is showing as well. So what that's showing is, and what we've seen, is that those strategies become now more transparent than the private market by definition. They become more liquid, again, also by definition. And of course, they're cheaper. Now, the returns are different. There's no question that the returns around those particular strategies are different than in the private market, but they're definitely cheaper than the private market. So it certainly has opened up a lot of opportunities for retail investors. I think what this could potentially, and I'd be interested to get the views of the other panelists, what this could potentially do for institutions is it now creates a liquid alternative inside of your non-alternative strategies. So alternatives become less alternative, if you will. So you're now putting your liquid alternatives, if you will, inside your core strategies. And around the periphery, you're adding your more private alternative investments. And I'd be curious to hear from the other panelists if they're starting to see that from their particular customers, because I do think that is a trend we can start to see.
Josh, are you focused on retail at all?
Yeah, I would say like it's the beginning of it's a trickle. So in other words, certainly we have now 5 public vehicles that we have a mezzanine vehicle, we have a corporate credit vehicle, we have a residential real estate an agency trading vehicle. So we've created a number of public vehicles that allow the retail investor to invest alongside of us. But when you look at it from an overall capital standpoint, it's probably less than 5% of kind of what we our funding source. So 95+% of what we're doing is in the institutional market. And quite frankly, when you look at the people that are going to get the worst hit when rates go up, the people that have been driving the increase in the fixed income markets and the decrease in rates, other than the governments just being on both sides of the trade, it's the poor retail investor, kind of going into corporate fixed income, into government fixed income, into agencies, with duration, right at the wrong time. And so it's a concern because the people that are going to lose that 27% that Wilbur talked about when rates go up to the average levels, if they do, are all the kind of consumers around the U.S. and otherwise. And so how is that going to affect the economy when literally hundreds of billions or even up to $1 trillion, when you look at the numbers of value is lost. And so, but I will say that over time, yes, I think that alternatives do a lot of great things, and I think transparency is going up across the board, and I think ultimately, sure, it should be a part of anyone's portfolio. The answer is not a 0% allocation to alternatives for anyone. Maybe it's 5, maybe it's 20, depending on who you are and the length of and when you need to spend, because obviously in alternatives, they're illiquid. You can't, you need to wait, you need to be able to ride through the markets. But I think that it is becoming more commonplace, but still small.
Vinay, what's your view on retail?
I agree completely. We see interest from, at the one end, pension funds, at the other end, very high net worths. You would imagine that very substantial net worth would be immune to shocks. That's not true. The crisis, was one hell of a surprise to everybody, including extremely high net worth individuals that I used to speak to as we even now. They are looking very much for contained downside. They're very focused not on what's going to happen in 17 3/4 years to this portfolio, but the downside deviation, and as they should. When I show you this bimodal distribution, I go on and on about it. What is important about this? What is important about a non-mean reverting world? It is that you will have very high serial autocorrelation of returns, not just on the good positive side, but also on the bad negative side. That is, if you have a downdraft today, the only reasonable thing to expect is a bigger downdraft in a week and something maybe terrible in a year. That is what a bimodal distribution does to you. And I think quite rightly, your clients should be concerned about downside deviation.
Wilbur, do you have any retail funds in your complex?
No, we really don't. What we're seeing at the larger institutional end is a kind of reverse phenomenon. People either co-investing with private equity funds or trying to do direct investing on their own. And I think this is going to be a very big trend, the sort of separate account trend. And we're seeing that quite a bit with our mix of clientele. So it's both at the little end, the retail, and at the sovereign wealth end, people going farther and farther into alternatives. And I don't see any reason why that trend would not continue for quite a little while.
All right, we have one other general question, which I'll set up here for a second. In the current environment, equity markets have been very strong. They've risen over 20% in the past year. Volatility has remained at pre-crisis levels for the past year. European bond yields have stabilized, so signaling that the turbulence in Europe, at least for now, is muted. Commodity prices have been flat to down. And despite the fact that central bank balance sheets have grown dramatically since the crisis, inflation has managed to stay in check. The leveraged finance markets are wide open. They're well exceeding 2007 volumes, as Josh pointed out, and the year-to-date 2013 volume has been unbelievable. Yet only a small portion of that volume has been attributed to M&A activity. And the main reason for that is sponsored buyout activity has been down dramatically. It's way down since the crisis. And in addition, global M&A activity in general is also significantly below pre-crisis levels. So given this, what you would think would be an excellent environment for M&A, and particularly for sponsors, why is activity down so much, and what's your outlook for M&A activity going forward, and how do you see that impacting the alternative universe? I guess, Josh, we'll start with you.
Yeah, again, so what's happening is that the leverage, the bar is open, the bartender's serving lots of drinks, and you can, kind of have a bunch of drinks and drive home and drive off the road. And I think people kind of went through that in the 06 to 08 period. And I think people are saying, wow, do I really want to pay 9.5 times EBITDA, which is the average purchase price for a transaction over $500 million for 2012, based on our data? Do I want to pay 9.5 times EBITDA for a company that is growing at 2.5%, which is the Bloomberg consensus forecast? And implicitly, if I do that, am I really betting that rates stay low for as long as they need to stay low for when I go to sell it? Because obviously, if you buy at 9 and you sell at 7 and you grow at 2.5%, you've lost money. So you really need to buy at 9 and sell at 9. And why are these companies trading at 9? And I think people are, logically saying in the more traditional private equity market, which is driven to a large extent by the leveraged finance availability, maybe I'll be a little bit more cautious. Maybe I'll try to do some different things like distressed, or as but Wilber's talking about shipping or energy investing, or in some cases people are going to the emerging markets, but people are trying to get out of the traditional private equity market, and so you're not seeing a lot of transactions. And the other thing is, these big mega buyouts. It's interesting if you look since 2009. I think there's been 7 transactions greater than that have closed greater than $5 billion. So I think if you look at 06 to 08, it was like 50. And so a lot of the volume was driven by these large mega transactions. Now, there are some, and certainly Heinz and now Dell prove that you can get a $20 billion deal done. But you're not seeing large private equity shops do a lot of it because it's not, I don't know that it's fun. I don't think it's a fundamentally sound, and again, there's lots of, you got to look at every situation, but as a general matter, it's not tremendously sound, in my opinion. Now, on the corporate M&A side, I think what's going on is sort of the same thing, but much more muted, which is, big companies do have a lot of cash. They've been deleveraged. The government's in essence taken the debt that was on corporate balance sheets onto its own balance sheet, but you're not seeing a ton of M&A transactions. And the reason is, in my opinion, the world's uncertain. Fundamentals are lagging behind technicals, and I think CEOs are saying, wait a second, do I really, some of the same things that private equity players do, what is the world, what's going to happen in Europe? What's going to happen in the US relative to healthcare cost, Obamacare, overregulation? Is China demand really going to keep going up at 8 or 9%? What's happening in the BRICS? And so all those uncertainties, which are not being reflected in the financial markets because of the backstop that the global monetary authorities have put under the financial markets vis-a-vis all the printing of money, in the real economy, people are saying, wait a second, I'm going to take a step back. And so that's my view as to why you're seeing transaction volume decline, and I think it's very sensible and somewhat prudent.
Vinay, what are your thoughts?
I agree. What Josh is saying is completely correct. I'll just add another thought, and that is that holding large cash balances is, virtually equivalent to self-insurance. Now, I don't think when interest rates are zero that you should be self-insuring. I mean, the markets are also giving volatility at the levels we see. It is probably not the most economical thing to do, but if that is not what you do, if you don't buy market vol, you need to self-insure for all the reasons that Josh described, and I fully understand why there is such a large amount of cash balances. It's a very uncertain world, and people are questioning the sustainability of the growth we see, and that question is uppermost. If we see a smidgen of growth and I get all this cash flow as the owner of capital, obviously I'm very happy. But my next question is, the value of this asset that I've bought is a function of what I can sell, and the people I'm selling to have not seen a wage increase in a decade or two. The ECI, I don't know if you saw the employment cost index today. This was a very, very low number this morning. It calls into question the sustainability of growth, that I think is what Josh is talking about.
Julia?
Well, it's hard to add much more to that other than I think you've seen a trend in companies. Obviously, in the last 6 to 12 months, those large cash balances are coming down. And what they've said is there's better uses for that, given the uncertainty and the slow growth, and that is either large dividend payouts or share buybacks. And those are probably better economic returns to the shareholders than mega buyouts. Having said that, I think there are still a lot of companies holding on to cash with the notion that eventually, 2 years, 3 years, economic certainty will start to come back, whether it's from a fiscal standpoint, a monetary standpoint, economic standpoint. We'll start to see more stability, and you will start to see M&A again, but I just think the other uncertainties are keeping it from happening today.
Good, Wilbur.
Yeah, I think if you want to be a serious investor, you have to get used to the notion that investing is a very lumpy process. Mm-hmm. Returns are lumpy, tend to be concentrated in certain time periods. Opportunities for investing also tend to be lumpy and concentrated. But sometimes, like right now, maybe it's better to hide, make 0.5%, and not lose 20, 30, 40%. And so I really think it's an extremely healthy thing and augurs well for long-term rates of return in private equity that the activity is down. I mean, you'd have to be crazy to think you should have record-breaking M&A activity, especially sponsor activity, with the market essentially at its all-time high. Why is it logical that those two would correspond? It's not.
What you're seeing sensible sponsors do and sensible alternatives firms do is sell. There's been, it was a while of wandering in the desert where the equity markets were not hospitable for many years. As you were pointing out, the corporate M&A market after the financial crisis, was not hospitable, and people built up larger portfolios, and kind of what sensible sponsors and alternatives firms are doing to a large extent is they're monetizing huge amounts of their portfolio into the current markets. And so that's a signal, at least from one group of people, as to what they think. When you see way more selling than buying by people who are supposed to be good investors, that's something at least that I look at, and it's certainly what we're doing.
Josh, you talked for a second about the mega buyouts, and there really were very, very few for a long time, and now we've seen a couple of, really significantly sized buyouts. Do you think this is the ice breaking and there's going to be more of this, or do you think these are just kind of one-off transactions?
I think they're one-off transactions. I think that, like I said, for the first time since 07, 08, you can get 15 to 20, even for the right deal, you get $20 billion of debt. So you could actually do a $25 billion deal, or more easily a $20 billion deal. But when you look at the Dell situation or the Heinz situation, those were very unique situations. And quite frankly, the large sponsor-driven private equity mega deals haven't really produced great returns. I mean, right. Some of them have worked, but to a large extent, when you look at the value creation on them on average, they haven't worked. And paying a premium on an already overvalued public company with a lot of debt at the peak of the leveraged finance markets is not sensible. So I think it is one-off. I think you'll see, certainly with the leveraged finance markets open, you'll see a few more, one-off transactions occur that wouldn't have otherwise occurred. But I think that by and large, the alternative managers are sitting this one out sensibly, and so that's the way that I would look at it. The other thing is, to a large extent now, with fund sizes being a little bit smaller, in each of these big transactions, you need, 2, 3, 4, 5 partners, and quite frankly, also I think that the lessons of 06 to 08, and then living through transactions where you kind of have to get 5 or 6 parties to agree, what to do. I mean, try getting 5 or 6 alternative managers on the phone. It's not an easy thing to do. So I think there are also execution challenges around it. So I think it just doesn't make a lot of sense.
Vina, you've talked a lot about volatility, and we saw in the charts there how commodities have been pretty volatile and they've been down. What's your outlook on commodities and how they play into the alternative universe?
Over the last decade, we've focused so much on demand, principally from emerging markets, as the driver of commodity prices, and I think rightly. What we've forgotten to focus on is the supply response. And in response to the enormous price increases you saw in 2006, 2008, it takes a while to make a mine or to improve or to increase agricultural yields. And I think the supply response has kicked in. The weather is the other aspect, especially for eggs. And I think it's the supply swamping demand that is the more important thing. It's not just, this means China is dead, and there's not going to be any growth going forward. I mean, that's not true. It is this one-off, the lumpy increase in supply that I think is depressing commodity prices. And as commodity prices become depressed, some projects are going to be canceled. When projects are canceled, the forward supply comes down. The demand, as we know, is rising, other than a complete disaster in these emerging markets. From China, it'll move to South Asia, hopefully North Africa. No, I'm really getting ahead of myself. But I think that demand story is a long-term story. The supply story is a lumpy story. And I think that's what you're seeing. I don't think they're necessarily saying terrible things about emerging markets.
Julia, you are, again, a little bit different background than the rest of the panel here. What opportunities do you see for alternative investment managers in underfunded pensions? There's a lot of talk out there and articles on underfunded pensions, and do you see any opportunities in that for alternative managers?
Oh, there's no question. I mean, well, let's first talk about corporate underfunded and versus public funds. I think they're going different ways. I think corporate pension plans, representing one up here, are less underfunded by definition, and in some cases completely funded. But what you're seeing on the corporate side is more of a liability-driven strategy. And on the edges, they're adding alternatives, however, for their growth perspective. So I think there is definitely opportunity for the corporate side. But more importantly, on the public side, I think this is common knowledge that they're heavily underfunded, and they are needing to alter their strategies. So I think everything we've set up here probably goes tenfold to public pension plans, and you will see and have seen a continued move into alternatives. The question is, where do they go? Not if they're going to go, but where do they go? They've already been heavy users of commercial real estate and private equity, so I think you're going to start to see them into other areas of focus, whether it's private equity, hedge funds, other strategies. So I think it isn't, they're not going to go. It's a matter of how much and where, and we're definitely seeing them increase it, and I think they're maintaining their exposures to private equity and real estate, and I think they're increasing their exposures elsewhere.
Thanks.
They're all going into Brevin Howard.
Yes.
That's the secret.
Or that's where they should be.
Thank you.
Wilbur, going back to commodity prices, with the recent trends in commodity prices, how do you see that playing into the buyout world, and are there ways that you see that you can take advantage of that?
I didn't hear your question.
Given the trends in commodity prices and where they are going, how do you see that playing into the buyout world, and how do you, as a buyout fund manager, how can you take advantage of that?
Well, we're very involved in shale gas, and that's been one of the more volatile commodities. You look at it over the last few years, it had a high of around $14 in MCF, got as low as about $1.90 not so long ago. Now it's $4 and some change. So that's pretty volatile, and it's volatile because it's driven not just by the economy and by regular supply demand, but we had the bizarre weather phenomenon a year ago, one of the warmest winters on record, and it was starting out that way again this year and then got very cold in the spring. So whereas at this point last year there was a big glut of oversupply, over inventory in natural gas, now it's at a very low level, and so we're getting much more optimistic about the price of shale gas itself. The other thing that I think will change that quite a bit will be if the Obama administration grants the export licenses. It's going to change things a lot, because natural gas in Asian markets and in European markets is more or less pegged to the price of oil. It's been a historical phenomenon. Not that there's any inherent correlation between the two, but in the US market, the two are totally unhinged. So you have natural gas sailing at a very small fraction of its BTU equivalents in terms of barrel of oil, whereas in other parts of the world, it's very different. So take US at $4 and change here, it costs you somewhere between $4 and $5 to liquefy the natural gas, which is what you have to do to make it shippable across the ocean, either by bringing it down to a very low temperature or putting it under pressure. Then you take it across the ocean and regasify it on the other side. That costs about $4 to $5 an MCF. So 4 and something here, 4 and something to get it there, only adds up to 8, but it's actually trading in the teens. So there's going to be a huge change in the price of the commodity in foreign markets, assuming these export licenses go through. But it will still retain for American chemical companies, American plastic companies, fertilizer companies, all of whom use this for feedstock, still going to retain the competitive advantage because of the cost of, as I described, liquefaction, transportation, and regasification. So there will be probably a 50% cost advantage to American producers, and I think it's going to rejuvenate the American chemical industry, plastics industry, and fertilizer. You've already seen announcements of $90 billion of CapEx, a lot from foreign companies in the US, some from Dow and people like that. So the whole commodity scene, I think that phase of it is starting to change. Similarly, in hydrocarbons, Brent, which is the big European benchmark, trades at a significant premium, although starting to narrow, over the US benchmark. And that's because of the ability to, in the US, you're not allowed to export crude. It's against the law. But you can export refined products. So it's changing the map there. And as more and more of the shale oil, or more properly tight oil, comes into being, I think you're going to see that gap close between Brent and West Texas. So there's no inherent reason why it should be as wide a gap, I think, as it is even now. I don't know, do you fellows do commodities at Brevin? Do you buy the theory of narrowing spreads?
Over time, yes, but the export ban, I think, is the single biggest factor that stops this. Also, where the oil is, for example. I mean, if you're talking about WTI versus Brent, how about Canadian oil versus WTI? I mean, that is another huge gap which has begun to narrow.
Right.
But that's thanks to the pipeline
Yeah,
not
but
being
a lot
approved.
of the Canadian oil is very high sulfur. It's
That's right.
not
That-
quite
that
the
I
same.
agree, but, yeah.
Not quite the same product.
Yeah.
Josh, you talked about looking into the energy sector. Are there any other natural resource sectors that you're looking at that you think are interesting today?
Sure. So another big trend is the major miners, Rio, BHP, Xstrata, Glencore, and so forth. They're selling midstream and downstream assets and focusing on, upstream so-called dig and deliver projects. So, where's the cheapest and I'm going to spend $10, $15 billion developing the lowest cost of iron ore, the lowest cost of copper, and the sort of the aluminum smelter on the Mississippi River. That's a mid-tier asset. I'm not interested as much in that. I'd rather sell that, or the downstream aluminum processor. We own a company called Constellium, which provides the aluminum Airbus and Boeing jet casings, and provides can sheet in Europe for sodas and other packaging. And we were able to buy that from Rio at a very attractive price, and in a so-called corporate carve-out where we ring-fenced the business and ultimately created a standalone business which had been inside of Rio. Those types of transactions, which are pretty complicated to navigate, are going on all over the place as the mining sector redeploys, in essence, what amounts to $300 to $400 billion of assets from midstream and downstream uses upstream, and it creates again another sort of set of opportunities for someone that can sort of manage through complexity. The other thing is a number of the minor, small miners are really funded by the Canadian equity markets and the amount of demand for different mini miners, if you will, is really volatile. And so if you're agile and smart, you can pick up some of the smaller miners at very interesting pricing. If you do it when commodities are, if it's a risk-off environment, and the equity markets will sell down those smaller companies, and you can kind of, if you're agile, pick up Canadian gold companies or other things at relatively interesting pricing. And so there are opportunities outside of energy, primarily in metals. Like agriculture is a bit harder. Quite frankly, what you end up with is many opportunities in the developing markets where you're planting agricultural products that need to grow and then ultimately be harvested. So, the cash flows, so you invest the money and then 5 years later, you hope you get cash flow. And it's actually pretty difficult, quite frankly, to really manage, crops in far-off places in areas where there's tremendous geopolitical and shrinkage and theft issues. And so we've kind of, to a large extent, the agricultural sector, even though it's a tremendously important sector and the need for food is, all over the world and demand is really, really good, it's very hard to get into unless you're a big food company. So that's been a bit harder. But for us, it's metals and energy.
All right, well, I see we're out of time. I'd like to thank all of our panelists for joining us and for all their excellent insights.
Thank you.
Nice to be with you.